In a good deal, the numbers work. Let me repeat that. In a good deal, the numbers work. Period. If the numbers don't work, it's not a good deal. All too often, I see people justifying why their deal will work and bringing emotion into it. Remember, this isn't your forever home. This is a rental, and it's all business. When most people look at a real estate deal, they fixate on the price. If you're investing for cash flow like I do, the price means nothing. Cash flow is the income a property generates after you've paid all of your expenses. Generally, this is your rental income minus your monthly overhead for the property. All that matters is if it cash flows or it doesn't. Cash flow is the most important aspect of real estate. What you really need to find out is what rent you can charge monthly and what your monthly bills are on the property and what they would be. When you subtract your monthly expenses from your rental income, you should have a positive number. That, my friend, is cash flow. If you're investing for cash flow, you don't pay mind to the value of the property. If it goes down in value after you buy it, it is of no concern to you. It will eventually go back up. All you are focusing on is how much money you are making per month. Here are the three components of cash flow. Income. Your income is the money that comes in from the properties each and every month when the tenants pay their rent. Expenses. Expenses are those that go out each and every month, like utilities and property taxes and insurance. Every property has expenses, and you need to make sure you are factoring all of the expenses in on every property. For real estate, the expenses include the maintenance services we provide on the property, utility bills such as electricity, water and trash, mortgages, and insurance. Also, capital expenses and vacancies have to be calculated into your numbers. At some point, you'll probably have a unit that's vacant, and it's important to calculate these into your equation. Net operating income, NOI. Net operating income, or NOI, is the difference between the income and the expenses. So if your income for your rent is $120,000 and your expenses for the property total $100,000, your NOI would be $20,000. I only invest in properties that have a positive NOI, and you should too. It's important to take a realistic look at how much cash flow the deal is generating. When you're seeking financing, the lender will want to see that the property is generating cash flow. Of course, it's great if your property appreciates in value, but it's more important to have cash flow each and every month. Doing your own numbers. So most new investors listen to their realtor. If their realtor says it's a good deal, they are all in. But you can't forget that your realtor works for a commission. Don't be lazy and blindly accept the numbers brokers or realtors are telling you. You can trust but also verify. It's only a good deal if the actual numbers cash flow. You shouldn't be feeding a property money each and every month hoping that rents will increase. That is not the kind of deal you want to step into. Verify the income. To be clear, the income is rent. The goal is to be 100% accurate and gather your own data. I'd like to use Zillow to see what similar homes are renting for in the area. Verify your expenses. The goal is to get extremely close to 100% accuracy on all of your expenses. Here are the expenses you have to calculate. Repairs and maintenance. Your property is going to have things that need to be fixed throughout the tenant's time there. You should put 10% away of your rental income for repairs and expenses. Utilities and HOA, or homeowners association. Normally the tenant pays for utilities, but you have to pay your own HOA. HOA fees can vary from $100 a month to upwards of $600 a month. CapEx. This is short for capital expenditures. There are large expenses that have to be accounted for. I like to pad my expenses with an additional 10% monthly for CapEx. If your property is a condominium in an HOA community, the HOA fees will typically cover the structure and most of the large expenses related to the structure. So for condos, you don't really need to add CapEx into your equation. Taxes. Each and every year you will have to pay property taxes. So that needs to be broken down over 12 months and added to your monthly expenses. Vacancy. You cannot assume that your unit will be filled with no gaps in between tenants. I like to calculate a minimum of 5% vacancy costs into every one of my equations. Insurance. You will need a landlord policy, sometimes called fire and dwelling. Get a realistic quote and break it down over 12 months. Your mortgage. Can't forget this one. Simply subtract this expense from your cash flow. So take all of these expenses and subtract them from your rental income. That is your cash flow. If the property does not cash flow, you need to start again, period. And trust me, this will happen most of the time. Do not get discouraged. If you found a cash flowing property, congratulations. You're on the right track.